Okay, so let us understand the solution through an example. So let me introduce the concept of stock market into this question so that we can understand the solution as well. So there is a term stock market which is well popular right now among students, investors, and all type of persons. So in stock market, what happens? There is a primary market. I will not go into detail because I'm just introducing the concept to make the example more clear. And there is secondary market. If an entity, let's say X company, has to raise capital, has to raise capital, then it will directly go to the primary market with an IPO, initial public offering. But whereas in case of secondary market, what happens when the initial investors subscribes to the initial public offering issued by the X company, then what happens? The shares, all the shares or all the instruments which have been issued by the company raising seeking to raise the capital will be got placed in the secondary market. And what happens in secondary market? The instrument will be placed like let's say suppose 100k shares, and there will be buyer and seller of these shares at different prices. A seller is a person who will be willing to sell his holding or number of shares in the market to acquire the money. A buyer is a person who is willing to purchase the shares or who is willing to increase its holding of shares by paying the money to the seller. So different prices determined will be at the buyer and seller will trade at different prices. However, the prices will be set according to demand and supply. Now what happened? Now what happens? There is a there is a very inherent risk in trading in the stock market. This is secondary market. So therefore, to prevent such anomaly that is actually present in the stock market trading, to prevent such anomaly, they establish the government has established SEC, which is known as Securities and Exchange Commission. Now what it will do? It will protect interest of investors, restrict insider trading, Now we can understand the first point, how it will protect the interest of investors by placing adequate and sound information among the market participants, and these are the market participants mainly dealing in stocks. A seller could be any person, financial institution, retail investor, or a portfolio manager, whatever be the person. And the buyer will also be of a same category, that will be equivalent to seller. So it will, the authority, it will protect the interest of both these participants by formulating of well-defined policies and well-defined rules and well-defined information on the platform so that they can use and execute their trades. Now in next point, we have highlighted that it restricts insider trading. And what is the insider trading? Do not go into detail, just take understanding that a person is a person who is employed in the entity whose stock is going to be traded in the stock market will likely to have much material information than anyone else. So if that employee will trade in the stock market, it will likely to he will likely to generate very very handsome profits than anyone else, because he has the insider information of that entity whose stocks are being traded in the market. And likewise, there are like eligibility, qualification of market participants. When I say market participants, it when I say market participants, it can also mean the stockbroker, the portfolio manager, mutual fund advisor, and lot more. So, for the sake of understanding, this this concept is enough for the current problem. So, as per the given problem, so the correct solution, problem 8, is C, based on the analysis of our concept. So, for the current problem, that's all what we have. Thank you.